There are a few ways a bull-put spread can work out. Whether the underlying share price stays above your strike price, dips slightly, or drops significantly, let's examine how each scenario impacts your profit or loss. Understanding these outcomes is crucial for knowing whether this strategy is a good fit for your portfolio. I'm Patricia Saylor, Managing Partner of Saylor Financial Fundamentals. I teach stock market investing for beginners to options traders, and I really want you to understand what you're doing before you dive in. Welcome to episode 4 of a 5-part series on trading bull-put spreads. In episode 5, we'll look at ways you might manage a trade that goes bad, but for now we're examining what happens if the contracts play out with no intervention. Let's look back at the QQQ trade we set up in episode 3. There are 4 possible outcomes and 3 important price points to consider. First, let's quickly recap the trade that we are using as our exemplar. That bull put spread is a 2-day contract with an upper strike on the short put of $521 and a lower strike on the long put of $519. It has a spread of $2, so there is potentially $200 at risk of loss. I received $9.68 income when I set it up on December 11th. If the share price stays above the upper strike, I get the best outcome. At expiration, both of the contracts are out of the money. They expire worthless and go away. Why? No one's going to force me to buy shares at $521 a share if they are worth more than that. And I'm not going to force or allow someone to buy the shares from me for $519 for the same reason. I made $9.68 and everything is wrapped up. It's time to look for a new opportunity. In the worst case scenario, QQQ has a big decline in the share price and is trading below $519 at expiration. For the purpose of this example, we'll say it's trading at $515. Now I have a problem. I sold a put with a strike price of $521, so I am obligated to buy 100 shares and pay $521 a share for them. I pay $52,100 for 100 shares of stock that is only worth $51,500. But because I also bought a put with a strike price of $519, I can now force the sale of the shares to someone else for $519 a share. So I can immediately sell the stock for $51,900. Because I buy it for $52,100 and sell it for $51,900, I lose $200 at the close of the trade. But actually, it's not quite that bad. Remember that $9.68 that I was paid when I set up the spread? Counting that income, I really have lost $190.32 on the entire sequence of trades. But what if the share price is between $521 and $519? In this scenario, the price of QQQ is between the strike prices of the two options. The sold short put of $521 is in the money. Since the stock is below $521, I'm obligated to buy 100 shares at $521 a share. So I pay $52,100 to purchase those shares. The $519 put that I bought is out of the money. Since the stock is above $519, that put has no value to me. The option won't help me sell the shares because they are worth more than $519, so that contract expires worthless. I have 100 shares of QQQ worth more than $51,900 and less than the $52,100 that I just paid for them. If I don't have $52,100 to pay for those 100 shares, I will need to sell the shares as soon as they are assigned to me at whatever the current market price is. So I pay $52,100, then immediately sell them for somewhere between $51,900 and $52,100. I lose money at the close of the trade, but I lose less than in outcome number 2. But again, remember that $9.68 that I got paid up front? That premium offsets the loss and might even mean I've still made a small profit. My break even is the share price of $520.90 rounded. So let's drill down a little deeper into this outcome. If the share price is below $520.90, I will end up with a net loss. But the closer the share price is to my break even, the smaller that loss will be. For the purpose of this example, let's say the share price is $520. I buy 100 shares for $52,100 and I sell them for $52,000. I lose $100 at the close, offset by $9.68 in premium from the trade setup. My net loss is $91.32. Which brings us to outcome 3B. It is still possible to make a small profit on the trades. If the share price is above my break even of $520.90, I don't lose any money. I buy the shares for $52,100 and immediately turn around and sell them for more than $52,090.32. So at expiration, I lose between $0 and $9.68. But the $9.68 premium I received when I opened the position still gives me a very small profit. For the purpose of this example, let's say the share price is $520.95. I buy 100 shares for $52,100. I sell them for $52,095. I lose $5 at the close, offset by the $9.68 in premium from the trade setup. My net profit is $4.32. In the free downloadable resources on my website, you can find detailed notes, terminology, definitions, and answers to the review questions for this content. The Episode 4 guide includes a clear table summarizing the 4 possible outcomes of a $521, $519 bull put spread with a net premium of $9.68. Here's how the profit and loss work in a bull put spread. Maximum gain happens if the stock price stays above the higher strike price and both options expire worthless. You keep the net credit you received when opening the trade. Maximum loss occurs when the stock price falls below the lower strike price. Your loss is the difference between the 2 strike prices, offset by the net credit you received when you open the trade. The break-even point is the higher strike minus the net credit received. In our example, it was $521 a share minus 9.68 cents per share, or just about $520.90. You might be wondering what exactly happens on expiration day and what you need to do. Your broker will probably take care of some of the closing trades for you automatically, but you should check on their policies to see exactly how they handle different scenarios. If one or both of the options go in the money, you might need to take some action to manage or close out the trade. We'll talk more about that trade management piece in Episode 5. Keep watching after the vocabulary, review questions, and homework assignment for the real outcome of the QQQ trade and a preview of the very important information coming up in Episode 5, our final episode in this series. Now, before you move on, let's make sure you've got the content we've covered so far and that you can apply your knowledge to a real trade. Remember, if you want an answer key and study guide, you can download one at no cost. Do you know all of these words and phrases, and can you use them in conversation? Out of the money, in the money, net credit, break-even point, assignment, probability of profit, maximum gain, maximum loss, exercise, as in exercising a put option, offset. Do you know the answers to these questions? What happens to your profit or loss if the stock price is above the higher strike price at expiration in a bull put spread? And why does this result occur? If the stock price falls below the lower strike price at expiration, how is your maximum loss determined? And what actions occur with the options in your bull put spread? What is the significance of the break-even point in a bull put spread, and how does it affect your outcomes if the stock price ends up between the break-even point and the higher strike price? In a scenario where the stock price is between the two strike prices at expiration, what happens to the sold and bought put options, and how does this affect your net result? Why is the net credit received when opening a bull put spread important in reducing potential losses or increasing profits? How does it apply to each possible outcome? How does the concept of maximum gain apply to a bull put spread, and under what circumstances is it achieved at expiration? For homework, let's try your first bull put spread analysis. Pick a stock or ETF you think would work for a bull put spread and figure out some key numbers: maximum profit, maximum loss, and break-even point. Don't worry, it's easier than it sounds when you take it step by step. First, select a stock or ETF, look at the options chain, select an expiration date, select two strike prices for your short put and your long put, record the bid price for the short put and the ask price for the long put. Here are the four key calculations you'll make. Capital requirements or risk. That's the difference between your two strike prices times 100. Maximum profit is your potential net premium credit. This is the premium you can collect for the short put minus the premium you must pay for the long put. Your maximum loss is the difference between the strike prices times 100 minus the net premium received. And your break-even point is the higher strike price minus the net premium received. If you download the notes and resources, you can copy a template I've provided and use it to organize your thoughts. While you're on the website, go ahead and check out my other resources and see if there's anything that could help you out. Oh, and in case you were wondering, my QQQ trade expired out of the money and I made $9.68 on a 2-day trade with only $200 of capital at risk. $9.68 might not sound like much, but the annualized return was more than 800%. In the next episode, we'll take things a step further by discussing ways you can manage these trades if they don't go your way. It's a fairly lengthy episode, but remember, not losing money is as important as making money, so you should probably watch it all the way through. We'll take an in-depth look at a trade repair I made on SPY, an S&P 500 fund that I trade in my own account. In the real-life example, it goes in the money the day before expiration, and I choose new strike prices and expiration dates for a roll. You won't want to miss my upcoming real-time trading videos where you can see this strategy being used in real market conditions. So check out episode 5 and make sure to hit that subscribe button and turn on notifications for this channel.